Good morning. My name is Kuval, and I talk with home buyers all the time and people that want to buy a home. And a really gross generalization, I'd assume 80 to 85% of the people that I speak with say that they want to wait to do the home search to buy a home until rates come down, which is totally fine. And it's up to them, right? Their decision. It's not my job to force people to buy or make people buy. It's just my job to provide information and help people make a good decision, whatever that is for them. Now, for the people that say that they want to wait because of the rates, maybe there are other factors that they need to consider. And saying I just need to wait for rates is the easy answer for them. I challenge anybody that does say we need to wait for rates to come down or we need to wait for prices to come down to really dive deeply into that narrative and into that saying in their head. Sorry for the screen doing that up and down thing with the volume. I hope it's not too annoying. But I challenge those people to really dive deep into what really is the reason that they want to wait. If it really is interest rates, cool. Make that decision, be strong in that decision. If it is prices, cool. Be strong in that. If it's other factors, like you might get a raise at your job and it might help you qualify to buy more, identify that. If it's you don't know if you have the job security in the industry that you're in, I know tech has had massive layoffs this year in 2023, identify that and stay strong in that. That's totally fine, and I respect the decision. But if it's literally just the rates or just the prices, and you have everything else in line, then I made this video for you to help you stay strong in your decision, or to just start thinking about maybe adjusting the verbiage of what you're saying, or starting the home search, right? Whatever that means for you. Now, I've been a realtor, a sales person in real estate for almost 2 years now. Before I got my license, I was an investor, you could say. I bought 6 units before I got my real estate license, two in Mississippi and 4 units in Las Vegas, where I was living before. I actually lived in LA for a while. Then during the pandemic, I was back and forth between Vegas and LA because my parents live in Vegas. And then obviously after the pandemic, right, because we're still technically, I don't know if we're still in it or not, I got my real estate license and moved back to LA. But I just bought another home. I bought a home that I was actually going to live in. The other properties that I bought in Mississippi didn't live in. The property in Vegas I bought to live in. And then the property that I got in LA just in January of this year, it's for me to live in. And I bought it in January of 2023. And obviously, we only know when we've hit like the bottom, so to say, of the market when we're looking in the rear view mirror. Like, we only know that the bottom has happened once it's passed, right? We can't identify, oh, this right now is the bottom, because we just don't know. The only way that we know for sure is when it's in the rear view mirror. And here's just an exercise. I want you to pause the video when you think we've hit the bottom. Watch my finger when you think we've hit the bottom. You may have paused it at the first time, may have paused it the second time, may have paused it on the way back all the way up, right? But the whole emphasis of that is that you just don't know when the bottom is going to happen. So those that try to time the market never really do well. That actively try to time the market. I think that when we bought our home we bought it in Inglewood, North Inglewood, back in January, I thought, looking back, we timed the market perfectly. We bought the home for either $15,000 or $20,000 under its appraised value. In addition to that, we also got $15,000 in credit from the seller to buy down our interest rate. It's a temporary rate buy down for the first 2 years. So that way we can have lower monthly payments for the first 2 years. And it's my assumption, and I'll show you some graphs in a second, that in a couple of months, if not a year or so, we will be able to refinance. And if rates are not lower in a year and a half, but they keep gradually rising like they have for the last couple of months, then I'm also cool with that, because if they keep rising, that means that I bought when rates were the lowest when I could have possibly bought, right? That's just how it works. And eventually when rates do come down, if they come down, then I'd be able to refinance. But it's not about timing the market. All right, that point aside, I have a couple of graphs that I want to show you, some economic data and then just some real estate data that might help you either stand strong in your decision to wait, or might maybe consider maybe buying something. I don't know. I have four different tabs here: Long Beach, Inglewood, Orange County, and Los Angeles County. And I could, also show you the entire, sales spectrum for whatever my website kind of gets this data for, because then you can see the bigger picture. But I know for a lot of people, having all that massive amount of data isn't necessarily the most important thing. It's important to be like hyper local in a lot of cases, because Inglewood is way different than Long Beach, even though it's only a 25-minute drive away, right? And Long Beach is way different than Orange County, which is literally a 5-minute drive out of my office, make a left, and you're driving for 5 minutes, you're in Orange County. It's totally different, which is why I have these four things here. I could add, Topanga, I have clients there. I could add Pasadena, but for now, just these four, just to kind of get the general idea. But it's important to be super, super specific with when you do want to end up purchasing something. You're looking at the data specific to that area or those areas where you want to consider living. So let's do this first. So when we're looking at the median sales price of homes in all of these areas, we're seeing them start to increase significantly in 2021, right? When rates were at their lowest in January of 2021, I think they hit like 2.6 was the par rate or whatever it was, right? Lowest. And they've continued to rise. Now, what's also happened since January of 2021 is rates have also continued to rise. Now, the idea is when rates go up, prices should theoretically come down, which is true, right? In theory, if rates go up, prices should go down, right? In theory, that's true. In practice, in real life, it's not really applicable, and it's not applicable because of supply and demand. It's the most basic thing from high school economics class, if you took that. When there's very little supply and very high demand, prices continue to rise no matter the other factors. And that's what we're seeing now. A couple graphs that I could show you, or I could pull up at the end of this, is since like 2010, after the Great Recession, builders just stopped building as many homes as they built from like 2003 to 2010. Like building slowed down completely. But all the people that were in their 20s then and now are starting to have kids, and population is growing. People need to move places for work and family and whatever other reasons that people might need to move. So there's a lot of people looking for homes and a lot of pent-up demand, but supply is just not increasing. Now, you may see the headlines for September of 2023 when they say inventory is growing and the amount of cancellations was the highest it's ever been for escrows. But you have to put that into perspective, right? Inventory is higher, yes, right now than it has been for the last month, maybe 2 months. And I can show you that here where we go to active listings for these, right? Like this is inventory. It was high in July of 2022, right? When rates increased significantly. High, right, in terms of this graph right here, high, but then it's just continued to go down and go down and go down, and you can see this little uptick here in September where it goes up again. But this compared to pre-pandemic, like this is where we're at right now. This is where we were at when the pandemic started. This is pre-pandemic, right? So inventory is incredibly low. But how many people do you know say that they have paused their home search, or they're waiting for rates to come down, or they're waiting for prices to come down, or whatever they're saying? Inventory is still incredibly low. And it's incredibly low as a result of the interest rates. I don't think that until rates come down a significant amount into the fives maybe, that we'll see a considerable amount of inventory. Because when you think about it, and again, I could show you graphs for this, you could even Google it yourself, between 2021 and middle of 2022, when rates were at their lowest ever, how many people that either bought a home or refinanced a home or maybe completely paid off their home or other property that they have? I think the stat is something crazy, like 60% of homeowners that own the home now with a mortgage, they have a rate under 5.5%. And then I think the next addition to that stat is 20% of Americans have no mortgage on their home. So add that to the 60, that's 80%. So the 20% of people that have a rate over 5.5, if they need to move, they're the ones that are going to be selling, right? If they need to move, those are the ones that are going to be selling. We're just not going to see the people that want to move or want to downsize or upsize sell and buy, because if they buy a home that's, if they sell their home and then buy a home that's $200,000 less with the higher mortgage, with a higher interest rate, their mortgage payments probably going to be super, super similar to what it is with the bigger home with the lower rate, right? So think about inventory when you're thinking about waiting. Now, again, it's not my job to sell you something that you don't want to buy. It's just my job to provide the data and then help you make a decision. And whatever that decision is from this, like, cool. And I will respect it, whatever it might be. But now let's take a look at the actual numbers. We'll go to 3 years. So in Long Beach, well, let's look at Long Beach and Inglewood real quick. In September of 2023, the median sales price in Long Beach was $750 and in Inglewood was $635. Let's go back to September of last year. Long Beach median sales price was $790 and Inglewood was $770. Right, so $790, $770 compared to $750 and $635. The median sales price has decreased significantly in Inglewood and by a little bit in Long Beach, but if you've been waiting for prices to come down, statistically now is your time to buy, right? Just based on the graphs, a year-over-year comparison. This isn't about seasonality anymore. This is like year-over-year comparison stuff, right? Apples to apples. Maybe seasonality plays a little bit of a factor, but if we're comparing last September to this September, apples to apples, seasonality doesn't really matter, right? Now, what's also happened between then and now is rates have come up significantly, right? Last August, call it, rates were probably hovering like low sixes, high fives. In November, rates were like mid sixes, high sixes. And then December, they were like high sixes. Maybe you got a really bad rate in the sevens, but not bad, but high rate in the sevens. But as you can see, the prices have come down, right? Year over year. Now, I want to show you this. I was at an event just last week. This was October 2nd, like 10 days ago. And you can see the different like decreases in rates right here, and what's happened with prices, right? So you can see, I can't see these times, and I'm just trying to spit off the top of my head what I can remember, but you can see that these are the identifying factors to where adjustments have happened in mortgage rates, and you can see the yellow is the mortgage rate. So where these circles are is where these two lines have crossed paths and stayed crossed, right? Crossed again there, and the circle is right here. It's kind of hard to see, but the circle's right there. Now, these are the federal funds rate and the 10-year Treasury note yield. You don't necessarily need to know what that means just to understand this graph. If you'd like to do more research, I urge you to do your own research for sure. But right after this crossing of the two chart lines, rates decrease from 11% to 7.5%. After the crossing of these two lines, right, the rates decrease from 8.5% to 5.5%. Now you might say, well, dude, they also crossed here and they also crossed here. Like, sure, yes, they did. And what happened? They crossed here, rates came down. They crossed here, rates came down, right? This circle, rates went down from 7.5 to 7 to 4.5. And here, I think this may have been in 2020 when the economy shut down, 3.5 to 2.5. Now we're up here, and these lines are crossing. They're crossing, and that means that rates will come down just based on this data. And again, if they come down, amazing, somebody can refinance. If they don't come down, okay, cool. You bought when rates were the lowest, where you possibly could have bought. Like, yeah, sure, you can look in hindsight and say, oh, I should have bought in 2021. Yeah, dude, you also should have bought in like 2013 or 2010, but we just didn't have the info that we have now, right? Let me show you the next photo. All right, so if rates are coming down, should I wait to buy? Sorry for the photos here, right? So if you wait 1 year, when rates are significantly lower to buy, your monthly payment is going to be $240 less in 1 year, based on just these projections with the numbers. $241 less. So let's add that up. That times 12 is about $3,000. Then let's say you refinance. Let's say the cost to refinance is $4,000. It's going to be about $6,800 in total out of pocket, the difference, the cost to buy now versus wait till later. Cool, sure. But remember, when rates come down, what happens to prices? They go up. The stat that I got in this session from a guy who studies finances is when rates come down by 8%, there are 5 million buyers that qualify for the price that they wanted to buy. I believe that was a stat. I can look at the exact like terminology in my notebook, but regardless, when rates come down, you're going to go back into the market, like you've said, and everybody and their mother is going to come back into the market and buy. And when there's competition, a lot of demand with little supply, what's going to happen? Prices will go through the roof, right? So let's say that the property's increased in value by $37,000 over a year, which is not uncommon. The average rate of appreciation across the United States for a year is like 4%, 4.6%, even including the years of the Great Recession, including the loss of value in like the 90s and the 70s and whatever you want to call it. The moral of the story is waiting for interest rates to come down just means you're waiting for more competition. That's what that means. Waiting for interest rates to come down means you're waiting for more competition. And again, if there's something stronger than just the rates, like you might get a raise, or you might do this, or this might happen, or this might happen, that's fine. But if you're literally just waiting for rates to come down, I don't recommend that. As a fiduciary, somebody that's supposed to save you money, I don't recommend that at all. Here's probably a better photo. You can see the actual numbers. Yeah, this is much better. Let's see, I have another slide now. Nothing on there. So let's do some like real math. Let's go to the mortgage calculator on Zillow. Move my face up a little bit. Let's say the average home price right now is $700,000 with an interest rate, we'll call it 7.825. Most buyers, the average amount people are putting down is 8%. Let's do 15%, right? With the average sales price being that, right? Because most banks are going to require 20% in equity to be able to refinance, but that 20% also includes the appreciation of the property. So 15% is more than enough. We could do 10, could do 8, and it's my assumption that refinancing is still going to be possible. Property taxes in Los Angeles about 1.25%. Home insurance, we'll call it $1,500 for the year. No HOA. The monthly payment of this is $5,300, right? Principal and interest. The mortgage insurance, because you're putting less than 20% down, which this usually isn't that high in a lot of cases, but just check with the lender to see what that number is going to be. But all in all, with the property taxes, insurance, and everything, it's $5,300. Now let's say you wait till rates come down. Let's say they go down to 6.8. So remember this: $5,300, 6.8. So it'll go down a whole percent. What's going to happen with prices? They're going to increase. Let's say they go up by $50K. It's increased your amount for the down payment, and your payment difference based on this math is, what was it, $500? $500, does that make sense? But do you really think that 1% is only going to increase the price by $50K? People are still overbidding for properties in Long Beach, because there's so little inventory, even with the higher rates of today, have like 4, 5, 6 offers on them. Those people that are writing offers, 4, 5, 6 people, they're not just stopping if they don't win that house. They're going to continue to write offers. So there's going to be those 5 or 6 people that are currently writing offers, plus you, plus everybody that said they want to wait for rates to come down, right? But that waiting for the rates to come down has also mean your down payment's increased and you're saving $500 a month, which I understand is a lot of money. But at the end of the day, I don't think it's only going to be $50,000 when rates come down by 1%. I think it's going to be closer to $75,000 to $100,000 when properties appreciate, because of all the pent up demand. And if it is $75,000, change in price when rates come down by a whole percent, then now you're only saving $350 a month, which again could be a big difference for you. That's totally fine. But then also it's increased the amount that you've had to put down. Now the whole kind of purpose of buying now is to help you save money out of your pocket, to be able to leverage the mortgage over the 30 years, right? Because you can keep cash in your account now. Maybe you have one less fancy dinner a month with your significant other. And then in like 2 years, when rates come down, if rates come down, refinance, and you're going to be having a lower payment, you would have saved the difference in down payment, 5, 10, 15K, whatever that number is going to be. And also, if you work with the proper accountant and you have the ability to, you could potentially be able to write off property taxes up to $10,000 for the year, and mortgage interest up to $750,000 worth of interest on a primary residence. Check with your CPA and see how, if they might be able to do that with you and your taxes and your situation. Everybody's different, right? W-2s, independent contractors, business owners, right? Everybody's different, but you might really not be thinking about the numbers the right way, so to speak. But all that being said, there's some cool programs out right now, not programs out, but there's cool ways to be able to decrease somebody's interest rate. And the one that I really love using with clients right now is called a 2-1 temporary rate buy down. It's the one that I used when I bought my property in January. It's a lower interest rate for the first 2 years of the loan. It is not an adjustable mortgage. It is a fixed rate mortgage where the first 2 years are lower because the seller has prepaid that interest for you as a buyer. Now you're like, why don't I do that for like 10 years? There's some calculations that the lender needs to do, that the max amount that a seller can pay to decrease interest for X amount of years. There's a certain calculation that lenders have to look at. But the 2-1 buy down works in like 95%, 99%, whatever the number is of cases that I work with clients for, or work with clients on, where for the first 2 years of the loan, it's lower. So a real life example, for me, I don't have like the exact dollar amount, but my mortgage interest rate from when I bought in January is 6.75%, let's call it. For the first year, because the seller's prepaid interest in X amount of dollars, my effective interest rate for the first 12 months, first 12 payments, is going to be 4.76, 2% less, right? The seller's just prepaid. Then from month 13 through month 24, so for the second year, it's 1% less, so it's like 5.74, whatever the number is. And then from year 3 through 30, it stays at the 6.74, 6.75, whatever the number is. It stays at that number for the 30 years, right, for the rest of the 27 years until we refinance. Now, that the goal of that is to be able to refinance in the first 2 years, right? But also we're getting the benefit, my girlfriend and I were getting the benefit as young professionals of having a lower monthly payment for the first 2 years so we could save more money to do whatever we want to do with that extra money. But there's ways to get creative to lower interest rates to help people purchase properties. They just don't know and they don't ask the right questions, because when somebody says they want to wait for rates, they're like shutting out all potential opportunity to learn or get creative about it. Now you may also be thinking like, well, I'm in a lease for 12 months. I don't want to buy out the lease. In most cases, leases, you can buy out of them for like 2.5 times, right, the monthly rent, right? So if you're paying $3,000 a month, you can buy out of it for $7,500. You can buy out of that lease for. I had success with a client a couple months ago in July where they were in a lease, and we had the seller give them seller credit at closing in the amount that it would take them to buy out of their lease. So the buyers still had to like cut the check out of pocket, right, to buy out of their lease, but the seller gave them seller credit to reduce their amount in closing costs. So it's like a net zero. So there's ways to get creative. It's just about if you really want to, and if it's not just about the interest rates, but there are other factors that you might be able to work through. Cool. Well, I hope this kind of helps put some things into perspective with the data and with the numbers. If you have any questions, let me know. And if you thought this video was valuable, let me know too. I'd appreciate that. But yeah, we'll talk to you soon.